I mean, I've had so many conversations with very intelligent, educated individuals, lawyers, law school graduates, MBAs, and they have never heard of the history of central banking. They've never heard of the history of um, fiat currency around the world, or that the Federal Reserve has only been in existence, for the last 104 years. They've never heard any of these things, or that there's actually no backing to the dollar whatsoever. So yeah, it's not taught in the mainstream.
Are you tired of overpaying for your gold, silver, and platinum bullion coins and bars? Then visit sdbullion.com today. SD Bullion was recently named the 177th fastest growing company in the United States by Inc. magazine. This is because they offer the absolute lowest prices in the industry and follow up with over-the-top customer service. So what are you waiting for? Go to sdbullion.com today and join more than 60,000 happy investors that save money on every precious metals purchase they make.
Hello everyone, this is James Anderson with sdbullion.com, hosting this week's SD Metals and Markets Wrap. Our guest today is Christopher Aaron from iGoldAdvisor.com. Christopher is a senior editor for goldeagle.com, as well as a former counterterrorism official for the CIA and Department of Defense. Chris is an independent analyzer of the precious metals markets, offering premium research to his subscribers. He's also hosts a free weekly video post on his YouTube channel, which I've been watching for years now, and I can't recommend it highly enough for those out there trying to seek non-hyped analysis of precious metal price action. So I just wanted to commend you real quick, Chris. On a personal level, I really have enjoyed your videos. I think I counted you have over 120 of them right now, and you started in August of 2015. So just hat tip to you for all the great work you've been doing and all the free content you've been getting to people who have interest in the space.
Thank you so much, James. It's a pleasure to speak with you and your listeners.
Great. So just I guess a quick introduction. We just talked before formally beginning the podcast, but for those out there that don't know, I'm James Anderson. I just started working with sdbullion.com. I've been working in the gold and silver industry now formally since 2008. I've worked with Mike Maloney at goldsilver.com. I've worked with JMBullion.com. I've worked with Kitco Metals in the past. So various bullion dealers I've worked with. I suppose, Chris, if you could give them just a brief background of what you do and who you are.
Yeah, thank you, James. Just briefly about my background. My training is actually in intelligence analysis for the government, and specifically, I focused in my career. I was part of the 9/11 generation, you may call it. Meaning I was in school when the attacks happened, and I wanted to do something in my career that I felt like I could help the country and in some way give back, basically in honor of my grandfather who fought in World War II. And I was not ready to enlist per se in the military, but I chose the best way that I could do it, which was to join the intelligence community. And I focused on mapping. And I draw a lot of analogies between mapping and technical analysis of the markets. And the best way I can describe it is that when I went overseas, I did 2 deployments to Iraq and Afghanistan from 2006 to 2009. We were being told something. And as a backdrop, I am a patriot and I love this country. But we were being told something about what was happening on the ground as far as the increase in stability, the control that we were gaining over areas of Taliban and Al-Qaeda. And what I saw with my own eyes, though, when I actually got on the ground, was a very different story. And so I draw the analogy to technical analysis in that we may have fundamental beliefs. There are things that we know about the precious metals and about the markets, the history of fiat currency, the history of central banking, the unprecedented nature of all the debt that exists in the world. Yet, at the same time, as we've seen from 2011 through 2015, it's quite possible for those fundamentals to be true, but for the markets to simply move against you for an extended period of time. I did start the channel and I did start working with goldeagle.com in late 2015. because as a technical-based analyst, there were certain signals that I was looking at, and I'll never claim to get every signal correct, but it's about trying to stack the odds in your favor. And so there were certain signals that I was looking at, such as gold versus the CRB commodity index in late 2015, which was actually breaking out at that time, even as gold was making its low at $1,045 per ounce. And the last time we had seen that signal was literally at the depth of the crash in 2008. And so I was looking at, that signal, which had repeated 7 years later, a few other technical signals, and it just showed me, hey, this is a good time to begin to publish my thoughts and my analysis, because perhaps the metals are making a turn, and that is what I believe is happening now.
Great, Chris, I appreciate that. One thing I'm going to bring up, because my hunch is anyone who's listening to this video, there's a good percentage of them who don't believe in technical analysis, because the old adage, I constantly see the comments saying, well, the precious metals are manipulated, so technicals don't matter. Do you mind just giving your standard rebuttal to that comment?
Yeah, and I do hear that quite often. And there's a certain segment of the population that will just they'll never be willing to listen to alternate arguments, and to them I can't really speak. But for those people who are at least open-minded to hearing that there may be ways of analyzing the markets, the thing that I would say is, yes, I do believe that there is manipulation in the precious metals markets. We've seen, I sometimes do short-term trading, and I see instances in which stops are flushed to the downside. We see this quite often. For example, on the flash crash in silver going back to July, we see this, every several weeks. So absolutely, there is manipulation. But if you believe that the manipulation is stronger than the market forces over the long run, I would just say, what are you doing in the precious metals market? I'm in this market because I know that over the long run, the market is more powerful than any attempts to manipulate it. That's why I'm here. The second thing I would say is that these manipulators, yes, and they exist, but these manipulators, they are also human beings. So there is merit, and all human beings move in patterns. And there is merit to analyzing the patterns that human beings take. That is basically the analogy from my work in the intelligence community. We are doing pattern of life analysis overseas. And I liken that to the financial market. So we are trying to look at what are the sum of human beings doing, including the stackers, including the traders, including the speculators, and including the manipulators.
Yeah, I definitely would agree. And even if they are painting charts in some form or fashion, it's a self-fulfilling prophecy in the sense that, people are constantly looking at those charts to make decisions based on, short-term analysis or medium-term trades, etc. So even if there is someone in there forcefully painting the charts, it's important to pay notice to it. And then secondly, like you said, the fundamentals eventually do win out, I think, when it comes to gold and silver, because there's just certain times when people want the physical product, and there's only so much in the world. So, like, for instance, whenever I want to, kind of calm my nerve, I just go back and look at an article that's on goldeagle.com, which is the London Gold Pool article, which reminds me that, yeah, central planners can get together and try and rig markets, but it only lasts for so long. So I'll put that link in the show notes so anyone listening today can go and find that article that I'm suggesting they read. Well, this is the weekly metals market wrap, so we should discuss the precious metals price action this week, if you don't mind, Chris.
Yeah, so let's take a look at it. We have gold is having a nice day today, up $16 in the spot market, just below the $12.95 level as this is being recorded. And silver, we're seeing a nice 21-cent move back up to $17.26 as this is being recorded. And just looking at some of the patterns here that we're talking about, the trend analysis from a technical level, there's a few things that I would say. One is that the pattern for gold right now, the major facet of what is happening in the gold market from my technical work is that we had a very clear downtrend, a very clear linear downtrend that formed in the price of gold from 2011 through just a few months ago. And so we're talking about from the high at 1923 down through some of the most recent peaks in 2016 and those peaks again here in 2017, just around 1300. And that linear downtrend, this is a very basic form of technical analysis, but I think it's often overlooked because it's so basic. And just as an example, the last time that we saw a linear downtrend break such as this was in the rise out of the crash of 2008. Going from those highs at 1033 in early 2008 through the crash lows, and then we saw a linear downtrend break in February of 2009. And so after we see these trend breaks, I think this is the challenging part from a technical basis. It does not necessarily mean that the prices are going to skyrocket. And especially if we go back to that example from 2008, there is often a process by which the market will retest a specific trend. And this retest can actually come at a lower price than the breakout point. And that is exactly what we're seeing today. It's just happening on a much longer basis. So if you were to look at the gold price going back since basically early 2013, we're talking over 4 years now. It's 4.5 years, where as a net sum, the prices are flat. So, I would say mainstream investors who are mostly focused on the stock market or other markets are looking at gold and they're saying, well, I'm not interested. Why would I be interested? Gold prices are moving flat for the last 4.5 years. But when we study some of these indicators, I mentioned gold versus the CRB index, this downtrend break. The other thing that we're seeing on the COMEX, yes, it's a paper market, but we are seeing record quarterly volume come into the COMEX just last quarter, third quarter of 2017, broke the all-time record dating back to 2011. So what it's showing you is that below the surface, there is increased interest, especially in the gold market at this time. And it's just a matter of time, I believe, to let this basing process play out. The challenge is that can go on for, a number of years, as we're seeing, and it wears people out.
Yeah, for sure. We're definitely, and just as far as my experience, it feels like we're in kind of a bear trap here, and it's been a long one. It's been years, right? So people, I think patience is running, it's becoming more precious than bullion itself in this industry.
Absolutely.
So we've covered your research methodology. Is there any additional information as far as stuff that you use for your technical analysis that maybe others might not use?
Yeah, I'm fairly big on the principle that I try to focus on is really price above all else. Volume is a secondary indicator, and there's some other indicators that I do use occasionally. I reference, for example, ratio analysis, gold versus the commodity index and where are we in that. But I do focus on what you would call classical technical analysis, which has to do with trend analysis, support resistance levels, going into the individual daily price action, which some would call Japanese candlestick analysis, which dates back, by the way, through, we're talking 300, 400, 500 years ago. Japanese candlestick analysis dates back to the rice markets of the last millennium, and traders, buying and selling rice needed to come up with ways to analyze those markets. So yeah, I do focus on that. I'm not big on, there's a lot of technical indicators, and I think this is why technical analysis can get a bad name sometimes, which is you will see certain charts and they'll have 6 or 7 indicators on the same chart. You'll have the price, you'll have the volume, you'll have Bollinger Bands, you'll have RSI, you'll have moving averages, you'll have McClellan indicators, and it just gets overwhelming, and I really understand that. So the form that I gravitate to, some people may find it simplistic, but it's actually the only thing that has ever worked for me. And we're talking about stacking the odds in our favor. Not that any one system will ever be perfect, but we are talking about stacking the odds in our favor. When I see an interesting setup. And I also participate in the mining equities, which is a very challenging sector to be participating in. But I do participate in this sector because a lot of the, in the mining sector, because a lot of the valuation metrics that we look at right now, whether you're looking at the gold and silver mining sector versus the broad S&P 500, so in other words, we're talking about the gold and silver mining sector versus the rest of the U.S. economy. On the charts, this is the lowest valuation that has ever been at. And we're talking data going back through the mid-1970s. Lowest valuation that has ever been at. So there is something to be said for, I think there can be a diversity of exposure in this market. But just so people know, I do consider the physical metals as my core, as my savings account that I look to hold for the long run.
Right. I get your point on the mining sector. It's extremely beaten down. And one thing that I used to hear constantly argued by Mike Maloney back in when I started working in the industry was, his argument was in the 70s. Across the board, Bullion outperformed most mining indexes until the 1980 peak was hit, and then Bullion totally underperformed, and the mining sector just exploded, and it did great after the peak of 850. So even though the precious metal prices were dropping from 850 down to say 600 or even down to 400, there was a lot of mining companies who were making money hand over fist, and so it was just dichotomy where Bullion outperformed mining sector before the peak, and then after the peak, the mining sector exploded and way outperformed the Bullion price.
Yeah, that's a very interesting point. We saw similar technical action at the 2011 peak, which is that the price of gold, peaked in September of 2011 at 1923 per ounce. But we actually saw the mining sector lagging for quite a while, most of 2011. And then we saw the peak in the mining sector occur actually after the peak in the spot price of gold. So yeah, that's an interesting phenomenon that plays out sometimes.
Nice. And then as far as your near and longer term price projections or ideas of what valuations could present itself in the future, is there anything that you venture to risk out there as far as ideas or concepts of where gold and silver could be in the next few months or even years?
Yeah. The next few months, I think, are going to be tricky. We are in the technical scenario of a retest, as I said, of that long-term downtrend in gold. And then with silver, it's a slightly different scenario. Long-term trend lines were broken back in 2013, 2014. There was a terminal bottoming wedge that formed between mid-2013 and the early part of 2016. This was the pattern that I was looking at in silver that was saying to me, hey, it's time to start sharing some of this because we're looking at a breakout coming here in early 2016. So when we look at these markets and we also look at the gold to silver ratio, for example, a very nice breakdown in the gold to silver ratio in favor of silver that occurred in that 2016 surge. The challenge is that the technical model that I'm using here is open to the possibility that gold could continue to grind, within recent ranges, even slightly lower. Nothing would be altered about this technical model, even if gold were to retreat back to about 1240 or 1230 over the next several months. So that would be very challenging because I think people would be looking at this and they would almost give up at just the wrong point, which is we're talking about that retest of the long-term downtrend. So the next 2 years, what I'm looking for is for 2018 for this retest to occur. The low may have already been in. This is not an exact science. We're trying to stack the odds in our favor for long-term investing. The low may have been in which case we are talking about a market that very well may consolidate with an upward bias through the next 3 or 4 quarters. And the big break that I'm looking at is going to be when does gold exceed that 2016 high of 1378 per ounce. My best analysis shows that that is due to set up sometime in the third or fourth quarter of 2018. So there is a period of, there's a period of consolidation here that I believe is ahead of us. But that's not a negative thing at all. This basing pattern that we're looking at, dating back through 2013, this is the most healthy pattern that you could look for if you're a long-term investor. We're talking about prices that are no longer falling as a net sum year over year, and we are starting to see stabilization, and a slight increase. Just quickly looking at silver, silver did outperform on that 2016 surge, hitting that high of 21.25 per ounce. It's been underperforming since then, and we actually see some evidence that silver may continue to underperform. For example, I wouldn't be surprised if even as gold exceeds its 2016 high, silver still lags below that relative level. So we may be looking at something where silver is consolidating, let's say, between the 16 and 21 level. This may even go on for another 12 or 18 months. This should not be frustrating at all for long-term investors. This is extremely healthy price action.
Yeah, you're basically building a base for the next moon rocket upwards, and hopefully a third phase mania for the precious metals, I assume.
Exactly.
Yeah. Are there any other topics you want to cover, Chris, that we perhaps didn't touch upon?
Yeah, the last thing I would just say is some very interesting data that came out of the World Gold Council over the last couple of weeks. And we're talking about physical demand here. And I mentioned before that we've seen record volume on the COMEX exchange. So we're talking about large institutions that are participating there. Some of them are just trading. Some of them may stand for delivery. But when we look at the physical side of the equation, and I'm looking at quarterly data going back through 2009, we actually see the lowest physical demand going back through 2009, just registered in this last quarter. Now, a large part of that comes out of India. Demand out of India has been the lowest in the last 6 years. India and China alone make up a significant bulk of the physical demand still to this day. But when we look at some other subsets of that, for example, on the U.S. side, we look at U.S. coin and bar investment. This is also, the previous 2 quarters have been the lowest on record since 2010. So, there's this dichotomy that's forming right now where we see tremendous volume coming into the exchanges on the COMEX, but we see retail investment, coins and bars, at 7-year record lows. In my opinion, this is a contrary indicator. We're seeing the small investor generally, not speaking to your listeners, of course, but across the U.S., we're seeing the small investors that are basically capitulating in the gold market. And meanwhile, we see institutions coming into this market and establishing positions on the COMEX. So I would say this is a very interesting time to pay attention to some of these price and volume indicators. And if this sets up the way that I anticipate, we will be looking at this as a contrary indicator. Basically, that the retail investor here in the United States got sucked into the stock market, as the stock market valuations were approaching some all-time highs as far as the dividend yields in the stock market being at record lows. The Buffett indicators they talk about, we're talking about the total value of all the stocks in the stock market versus the GDP of the United States. We look at a lot of these indicators, and the stock market is on par with the most overvalued that it has ever been. So it just looks like to me, like as we're seeing this healthy long-term price action in the metals themselves, the retail investor is largely no longer in this market. And I would say that's just a perfect setup for long-term investors at this time.
Great. I can definitely add to that a little bit. I just saw recently the Silver Institute and Reuters came out with their forecast for 2017 saying that that silver bullion coin demand is down 37% forecasted for the year on year, as opposed to the year prior. And if you compare it to 2015, it's almost down 50% in terms of physical demand for investment grade silver, coin bar, etc. So, it does sound like the public is, the retail public is kind of throwing in the towel and losing losing their belief, whereas, obviously on the COMEX, the trading volumes are still record highs and growing.
Yeah, that's exactly right. And I would say that's, in my book, that's a contrary indicator. Mm-hmm. So, again, we are not looking at a scenario here of skyrocketing prices. And I think that's why a lot of people, a lot of retail investors were turned off to this market because they were sort of expecting that at any moment, silver is just going to go to the moon, so to speak. Right. We don't see evidence for that at this time, but what we do see is that the base is being built for a long-term move to come, within the next couple of years is what really looks like is setting up to me.
Well, Chris, thanks for coming on the show. And for all those listeners out there, we appreciate you listening in to the SD Metals and Markets Wrap this week.
Thank you very much, James, for having me, and best to all the listeners.